Hi, welcome back. In this session, I want to focus on investing in youth, with youth defined in terms of the corporate life cycle, in younger companies, in high growth companies, perhaps even in startups. Let's start with the startup part of the life cycle. The investors at the startup phase of the life cycle tend to be predominantly venture capitalists. It's starting to change a little bit, but it still remains true. These venture capitalists supply capital to the company in return for a percentage ownership of the company. And we've talked about venture capital and how venture capitalists play a role in transitioning these companies from being idea companies to actual businesses. In this session, I'd like to look at, do venture capitalists generate a return for doing so? Do they earn a higher return than investors in public markets? And the evidence, as they say, is mixed. In this session, we'll also argue that venture capitalists, and we've made this point before, tend to play a pricing game. They're not value people. They judge based on entry and exit. We'll talk about how the venture capital pricing game can play out in terms of what you observe as the pricing of very young companies. If you look at the venture capital pricing game, and we talked about how this is played, to price a company, what venture capitalists often look at is first other venture capitalists who price the same company. In other words, they look at the previous pricing round for the same company. If in the previous round this company was priced at $1 billion, you're very likely to see that as the starting point. And perhaps you will have a down round or an up round, but the previous pricing becomes an input. Second, venture capitalists also look around and look to see other companies like theirs and what other venture capitalists are paying for those companies. There's a caveat though. Unlike publicly traded companies where those peer group companies are traded round the clock, you have an updated price. In venture capital, as you're looking at other private companies, the last pricing you have for a company might be stale. It might be 2 months ago, 6 months ago, a year ago. And there are a lot of subjective adjustments you got to make, from not just in terms of business model and total addressable market, but who the founder is. And thirdly, you can try to price your company based on publicly traded companies. This will work if you're a venture capitalist in a young company which is large enough that it has the potential to go public. So you can do pricing against other people who are pricing similar companies, your own company being priced in the past, or publicly traded companies, but it's still a pricing game. The bottom line though is, when venture capitalists price companies, there are 3 problems with pricing. The first is they're working with small samples. The public company, I might have 50 or 100 software companies that are publicly traded. If you're a venture capitalist in a private company, you might have 5 or 6 or 7 companies, small samples. And if they're all private companies, their pricing might not be updated. It might be stale, so that's a problem. And the transactions themselves are opaque. What does that mean? We talked about how when venture capitalists pay $50 million for a 5% stake in a company, it doesn't automatically scale up that the company is worth $1 billion, because venture capitalists can get special terms, they can get protections on the downside, makes it difficult to extrapolate to pricing. The bottom line though is, when you see venture capital pricing for companies, that pricing will have more noise, error associated with it, will be much more subjective than public company pricing. Again, I'm not using subjective as a bad word, it is what it is. It will lag the market. In other words, the public equity markets are down 30%. Venture capital will be down, but it might take 6 months or a year to show up because of the way the process plays out. And because of the nature of venture capital pricing, where you're letting another venture capitalist pay for a company affect your pricing, can be a feedback loop. What does that mean? If you have one rogue venture capitalist who chooses to overpay for companies, that rogue pricing can push up the pricing of other companies around it. And finally, even if you price the company and you believe the pricing, it might take a while for that pricing to play out, because the time horizon with private companies is longer. You don't have the market doing the constant updating. So we can see that venture capitalists price companies and they take positions and then they cash out. They cash out by selling their position to another venture capitalist, taking the company public, or selling to a public company. Let's look at the returns that venture capitalists make. And if you look across all venture capital investors, it turns out that there is some good news. Venture capitalists on average do make a little bit more than public market investors, depending on the time period you look at. So in this case, you see VC funds, especially if you look at a longer time period, make more than public market investors, but perhaps not as much as you think they do. Let's take a 10-year time horizon. Public market investors between 2012 and 2021 made about 17%. Venture capitalists made about 21%. Does that mean venture capitalists make excess returns? Not necessarily, because they're also facing more risk. So in the aggregate, venture capitalists earn slightly higher returns, but they have years where they lag public market investors, as you can see in 2021. But here's the feature of venture capital that makes it interesting. Among venture capital investors, there's a very skewed payoff. In other words, their big winners deliver huge payoffs, but they have lots of losers. If you look at a venture capitalist portfolio, only 20% of the portfolio might win, but those winnings tend to be large enough to cover the 80%. That's unlike a public market equity investor, where if you buy 100 stocks, you're never going to see 95 stocks down and 5 stocks up and the portfolio do well. But that can happen with venture capital. This graph, actually, I look at the payoffs that you get on different venture capital investments. And you're going to see a few investments deliver huge payoffs and lots of investments where you make nothing or you lose your money. Now, among venture capitalists themselves, there is an interesting component of venture capital returns that I think is worth emphasizing. In public markets, when you look at active investors, in any given year, you have winners and losers. Some mutual fund managers do much better than the market, some do worse. On average, mutual funds underperform the market. But if you look at the winning mutual funds, they almost never have staying power. There's no consistency in overperformance with public market investors. With venture capital returns, there seems to be more sustainability. The most successful venture capitalists seem to be more likely to stay on as successful venture capitalists, which raises an interesting question of what makes venture capitalists have staying power and public market investors don't. One is they might bring in something substantial to the process that other venture capitalists can't meet. We talked about how venture capitalists have to pick the right founder and provide help to startups to become businesses. Maybe some venture capitalists are better at doing that than others, and that's going to be a sustainable advantage. There's a second advantage. If you're a successful venture capitalist and other people know that you're a successful venture capitalist, it gives you benefits. You're a startup looking for venture capital. You want successful venture capitalists, somebody with a big name investing in you, which means you're often willing to give better terms to a recognized successful venture capitalist than to somebody who doesn't have that reputation. So success breeds more success, which might explain the sustainability of venture capital success. If you look at the most successful venture capitalists and you try to figure out what do they do that other venture capitalists don't, I can think of three things. One is they are better at pricing. Okay? Whether it's because they've been around these companies longer or whether it's because they look at a metric that they should be looking at, they're better at pricing. They're also better at influencing how the companies that they take positions in get run. They actually make a difference in how these companies get run and essentially in whether they succeed or not. And they're better timing. The key to being a successful venture capitalist is timing. You get in at the right time. You get out at the right time, you're going to be a successful VC. In fact, you can pick the right companies, but if you don't exit at the right time, all that success comes to naught. So if you're looking for success, those are the things that seem to set apart successful venture capitalists. As to what determines that success, the very best venture capitalists, I think, are good judges of stories and of founders. Both are critical at very early in the process, because remember, early in the process, the value of a company is driven by the story it's telling, not by its historical data, not by its number crunching. The very best venture capitalists are good at assessing stories and asking the 3P test or making them pass the 3P test. Is it possible, plausible, probable? And they're also good judges of founders. Remember, we talked about how when you have a startup, you have an idea and you have a founder. Some founders are more capable of turning ideas into business models, and the best VCs are better at assessing those founders and putting their capital with those founders. The very best VCs also tend to be more protective of their investments as the company grows. You can't just buy and hold as a VC. You invest in a company, you get in at the right price, and sometimes you might get out at the right price. So, being protective of your investments, being aware of both the upside and the downside. The biggest challenge at young startups when it comes to value, we talked about, is failure risk. 2/3 of startups don't make it to year 2. The very best VCs seem to be a little better at assessing that failure risk than other VCs. And no matter how good you are as a VC, you got to spread your bets. If you put all your money in your most promising company, you're asking for trouble. So I think this notion of concentration cuts against the grain for successful VCs. You have to spread your bets across multiple startups that you think have potential. So that's a venture capital business. Tough business to win at, but if you can win, you can keep winning. That is a big plus of being a successful venture capitalist. Let's turn to growth investing in the public equity markets. It can take 3 forms. Perhaps there are more, but I'm going to list 3. One is to invest in private companies as they go public. After all, these are high growth companies that are going to the market for the first time because they need the capital to keep growing. We'll talk about IPOs and whether you can make money around what happens in the IPO process. The second is to just bet on growth. Invest in the companies with the highest growth rates. We'll talk about both investing in companies with the highest historical earnings growth or historical revenue growth, as well as investing in companies with the highest expected growth. And there's a third strand of growth investing that we can call growth at a reasonable price. What these investors try to do is buy growth companies where they think the price is right. You're buying good growth at a low price. Let's start with IPOs. The story of IPOs is really around the offering day. When you look at IPOs, if you remember the process of an IPO, for much of the last century, bankers have led initial public offerings. They set an offering price, and because they guarantee the offering price, they tend to discount the price relative to what they think they can get. Not surprisingly then, on the offering day, the price jumps from the offering price to a market price, and it happens almost instantaneously, right at the listing. That jump can be 10, 15%. In this graph, I look at the IPO returns on the first day, and these IPO returns translate into a jump in the price, and you can see, especially in hot IPO markets, that jump becomes much larger. 1990s, on the offering day, these companies jump 50, 100, 150%. Now, as a founder owner of this company, or a venture capitalist of the company, this is money left on the table, but it's a feature of IPOs. Let's turn this process around. If you're an investor looking at this graph, you're going to be tempted, right? You're saying, what if I could subscribe to every initial public offering at the offering price? Wouldn't I be able to make money from that jump? We'll come back and talk about that. If you track IPOs after the offering day, the numbers start to reverse. So this is a study that looked at the years after an initial public offering, what IPOs do relative to the other companies in the sector. So the green are the returns on IPOs in the 5 years after the IPO. The red are the returns on the other companies in the sector. It looks like in the years after the public offering, IPO returns lag the returns on more seasoned companies in the sector. So you have two sets of results here. One is what happens around the IPO, where you get that jump in the price partly because of the way IPOs are priced. And the second is this post-IPO return where things don't look that good for IPOs. If you look a little more closely at post-IPO returns across time, you can see there are, ups and downs over time. It's not as if you're going to get the same effects. Here you look at the post-IPO returns on a market and a style-adjusted basis. The bottom line, though, remains very much the same. Across the board, if you look at after the adjustments, IPOs are not great investments if you get them after the offering day. Perhaps if you get them at the offering price, you get that first day jump. But if you buy them at the end of the first day, they're not great investments. So is there a way as an investor you can take advantage of it? One is what I call the bludgeon approach. You look at that first graph of what happened the offering day and you say, what if I could subscribe to every IPO, buy 1,000 shares of every IPO? On average, I should make money, right? Not so quickly. Because let's say you decide to adopt that strategy. You start a mutual fund where you look at every IPO and you ask for 1,000 shares of every IPO. Are you going to get 1,000 shares in every IPO? No. You're going to get all 1,000 shares in some IPOs, the overpriced ones. You're going to get well below 1,000 shares for underpriced. So if you have a really underpriced IPO, if you ask for 1,000, you might get 200 shares. You know what your end portfolio is going to look like, right? Not that good. You're going to be underweighted in the most underpriced offerings and overweighted. There have been people who've tried to take advantage of those offering day returns, and they don't seem to succeed precisely because of this problem. There are a couple of ways you might still be able to make money. One is if there is some kind of an allotment system that's biased. Many investment banks often will give IPO shares to their most preferred clients. Maybe you're one of those preferred clients. Maybe you can take advantage of the system and make money. But that's going to be a fairly niche strategy. The other is maybe you bet against the herd. Rather than be with the herd and try to buy stocks on the offering day, you sell short at the end of the offering day and try to take advantage of the post-IPO underperformance of IPO companies. Again, a tough strategy to pull off, but you can see the potential. There's another version of the IPO strategy. We try to ride the wave. What does that mean? IPOs have hot markets and cold markets. In hot markets, you get lots of IPOs. You get that big jump on the offering day. Cold markets, you get the reverse. You might decide to play the wave, in which case you're playing a momentum strategy, because in good years, when the market is doing well, you have lots of IPOs, you will make money. In bad years, you will lose money. Over time, hopefully, you can walk away with the return. But it's very much a momentum strategy, very similar to buying stocks in good years when stocks are going up and staying away from them in bad years. And the other thing to remember when you ride the wave is there is going to be a sector focus in your portfolio. Why? Because if you look at IPOs, they tend to be bunched up in some sectors. It's not across all sectors. You're going to end up with an overly tech-focused portfolio if you bought stocks in the 1990s. A lot of dot-com stocks. And that can be a problem if you think about sectors correcting. So can you be a discriminating IPO investor? Perhaps. And I'll give you a pathway. If you can only apply or try to invest only in those IPOs where you think the odds of underpricing are greatest, you remove that risk you had with the bludgeon approach, right? Well, you can try. But to do this, you need pretty good valuation and pricing skills. We talked about how difficult it is to both value and price IPOs, young companies. If you can do that, maybe you can take advantage of that skill. The second is, as we talked about these cycles, it will be a cycle where you will have lots to invest in some years and nothing at all in those cold years. You got to be willing to live with that. So IPOs, potential way to make money. I've seen very few successful investors who can consistently win with IPOs, but maybe you can be the exception. Say, what about growth investing? Just invest in companies which have grown their earnings a lot in the past, historical growth. This is a graph where I look at the correlation between growth rates in 5 years and growth rates in the next 5 years. I'll give you in a minute. You're saying, who cares? It's a statistical number. It actually will tell you whether investing based on past growth will help you. When you look at the correlation between growth rates and you look at correlation between, this is different time periods. The correlation between past growth and future growth tends to be very low at small cap firms. It tends to get higher at large cap firms. You're saying, why does that matter? When you're investing based on past growth, you're buying stocks with high earnings growth in the past, you're implicitly assuming it'll continue into the future, right? This graph puts a caveat there. Say it's maybe that'll happen, but there's a lot of noise, and with small companies, it might never happen. So you're buying small companies with high historical earnings growth, expecting that earnings growth to continue. You might have a lot of disappointment in your portfolio. You're saying, what if I shift to expected growth? Well, first, remember, you can't estimate expected earnings growth for every stock in the market. So if you're using expected earnings growth, you're using somebody else's estimates. In the US, you can get consensus estimates of earnings growth for companies. You're saying, hey, why can't I just buy companies with high expected earnings growth from analysts? Well, it's because it's built on two of the weakest links in investing. One is analysts are not that good at forecasting long-term earnings growth. They might be good at forecasting next quarter's earnings, but they're not that good at forecasting long-term growth. And the market might already be pricing in that growth. Put simply, investing just based on growth rates, whether it's historical or expected growth, doesn't seem to have much promise. There is a version of growth investing which again is almost a bludgeon approach. And in fact, when growth investors are critiqued, it's often based on this version of growth investing. You just buy high PE stocks. He's saying, why is that bad? Because history works against you. When you look at the history of returns on low PE versus high PE stocks, and basically I have the low PE stocks in the blue and the high PE, you can see that as you move across the deciles, the lowest PE stocks have earned higher returns than the highest PE stocks. History works against you if you just go out and buy high PE stocks. Now, before you give up, there is something that might work in your favor. There are cycles where high PE stocks outperform low PE stocks. So cycles can relate to periods when growth is scarce. High PE stocks outperform low PE stocks. If you can find a cycle which you can take advantage of, maybe you can adopt a strategy of investing in high PE stocks, but you got to be a timer, a macro timer, a market timer to pull this off. So investing based just on growth rates doesn't seem to offer much promise. Investing just on high PE ratios offers promise only if you're good at calling cycles. And those cycles can come from either growth being low or the yield curve being downward sloping. It turns out that high PE stocks do much better when the yield curve is downward sloping than upward sloping. Again, a variant of growth being scarce. So maybe you're good at calling cycles. But let's look at growth trading strategies as opposed to investing strategies. Growth trading strategies, you're trying to trade often on earnings momentum. Not the growth rate itself, but how much is the growth rate changing over time. And basically, when you look at trading strategies, these trading strategies are built around analyst expectations and how much earnings come in relative to expectations. In its simplest form, what do? You invest in companies where the earnings come in above expectations, hoping to take advantage of the drift. The other version of this strategy is you look at companies where the analysts are revising earnings forecasts upwards, and you invest in companies with upward revisions. There's some empirical evidence that both these trading strategies earned returns. Now, forecast revisions seem to suggest, so when you get revisions upwards in earnings, it seems to lead to high returns, but more likely to be so when you have big divergence among investors. We have disagreement. But timeliness matters. You've got to get in at the right time and get out at the right time. And even if you succeed, you're talking about not 10% more than the market, but 2 or 3. They're mildly positive excess returns, but mildly positive is not bad. So can you trade around earnings revisions and earnings surprises, perhaps, and make money on it? Okay? But there are pitfalls here, which is the dependence here on two of the weakest links in markets. One is that earnings reports come from firms, and companies have learned how to massage earnings reports and analyst forecasts of those earnings. So analysts all you might be capturing then is analysts following, because when analysts forecast earnings and they revise their earnings upwards, their clients get that information, they might trade on it. You might be just benefiting from the fact that the analysts who are influential are pushing up the prices because of the clients that follow what they do. It is a short-term strategy. It eats small excess returns. So if you're going into growth trading, do it with realistic expectations on what you can get out of growth trading. Which brings me to growth at a reasonable price. Peter Lynch was the person who brought this to the surface. And in a sense, he said, look, just because I'm a growth investor doesn't mean I don't care about value. I just care about value in a different way than the traditional value investors. So one of the multiples that has come out of this growth at a reasonable price is PEG ratios. This is actually the results of studies which look at classifying companies based on PEG ratios, from low PEG ratios to high PEG ratios. So the blue is the lowest PEG ratios, the bright blue, and the light blue at the other end is the highest PEG ratios. And it looks at different time periods. And I'll give you the good news. The good news is across every subset, every sub-period, the lowest PEG ratio stocks have earned higher returns than the highest PEG ratio stocks. Now, before you get too excited and do something rash, it should be noted that I haven't risk adjusted these returns. The lowest PEG ratio stocks tend to be the riskiest stocks. And if you adjust for risk, maybe much of this difference will disappear. Maybe PEG ratio might not be the way you do it, but if you can get growth at a reasonable price using whatever variant you want to bring in growth into your pricing, there is a possibility here that you could walk away with returns. Now, will those returns be high enough to cover your risk? Well, I guess that depends on how well you screen these low PEG ratio companies for risk. So let's sum up what we've learned about growth investing. Growth investing cuts across the spectrum. It looks at everything from venture capital investing, which is activist growth investing, to passive growth investing. We buy high PE stock, high growth companies, even low PEG ratio stocks. But it can also include within it people who try to take advantage of growth investing by trading on growth, trading on earnings revisions. If you want to succeed at growth investing, I think there is a pathway, but I think it requires that you be clear about what you need to succeed in growth investing. The first is perhaps you're a little better at estimating growth than other investors. Maybe that's where your skill set lies. If that is your skill, maybe you can exploit it, take advantage of it by either trading on growth or investing in growth. The second is maybe you have a longer time horizon than most other investors. If that's the case, you might be able to buy high growth stocks when they're beaten up and wait for them to recover and make money. In a sense, you're playing off against the fact that many of the other investors investing in growth companies are not taking the time to assess the value of growth, and perhaps you're better at assessing that value than they are. But ultimately, I think growth investing has a cycle component to it. If you're good at forecasting macro and market cycles, then I think you can exploit that by using growth investing. After all, high PE stocks might not earn higher returns than low PE stocks. In fact, they earn lower returns than low PE stocks over long periods. But in periods where growth is scarce and when the yield curve is downward sloping, it looks like the high PE stocks outperform. So if you can call those cycles, perhaps you can take advantage of them. Now, growth investing may be much more difficult to succeed at than value investing, but because it's so difficult to succeed at, maybe that's why growth investors have more sustainability. If you succeed, you're more likely to stay succeeding. That's just my hypothesis. I hope you found this session useful, and thank you very much for listening.